Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool and one of the founding partners of the Dividend King subscription service on Seeking Alpha. Today's video is really going to talk about valuation from two perspectives, but the real purpose of what I'm trying to accomplish here is to point out the importance of time. Time is really something that comes into play when you're talking about valuation. If you're looking at overvaluation, time, as I stated in the written portion of this article, can become your adversary or your worst enemy. Because people often talk about time in the market rather than market timing, and I basically agree with that. However, I do believe that you should be entering the market at sound valuation, because if you don't, if you invest when the valuations are too high, you can go through extended periods of time of losing money or having very poor returns, or dead money as some people like to call it. And then conversely, if you buy a stock when it's undervalued, it's typically buying an unpopular stock, and it might take a long period of time before you actually reap the rewards that the business that you're invested in is capable of generating for you. And I'll be covering that both sides. But the first thing I want to do to kind of set a backdrop, if you will, is take a look at the S&P 500, or the average stock. Some people promote index investing, and I get that and I understand that, and you can do pretty well over time. Even if you look at the S&P from this perspective, if you look at buying it, because I can only go back to 2000, the end of 1999 or 2000, you can see the valuation of the S&P was very high. Now let me give you some perspective. This blue line is a PE of 18. It's a valuation reference line. The orange line is a PE ratio of 15. And if you look closely at this graph, you can see that for the majority of the time, as I stated in the written portion, the S&P 500 has traded pretty much within that 15 to 18 times earnings range. Now, there were two outliers that I mentioned. You know, the period where you ended into 2000 and so on, when the valuations got very high. Obviously, here you're looking at a PE of 28, which is above the 18 and, of course, above the 15. And then even as we came out of the recession, the market was pretty attractively valued. It started getting fully valued in 2015. And then by 2016 to current, with a little bit of, one exception in between, we now have a situation where the market is fully valued. So people talk often about the market being overvalued. I generally agree, but I don't think it's as overvalued as some people think. In other words, this is a relatively high valuation for the market. And if I go back in time and look at a time when I would have seen the market trading at a 20-ish PE like that, I'd be looking at something like 2002 or so. And, that did lead to a period of time where the returns on the S&P were rather weak, averaging about 4%, and that includes dividends. Of course, that also included going through the recession. It also included a dividend cut. But the main point is that if you pay a very high valuation for a stock or the market, and I'll be elaborating on this, you could go into extended periods of time where even though you've stayed in the market for a long period of time, you don't make any money. But the real reason for showing this S&P graph is to point out that the markets are fully valued now, but they're not overvalued. Now, I also talk about measuring performance, relative to fair value. So let's say I bought the S&P index fund in May of 2010 when this was trading at roughly a 15 PE, which I would call fair value. That's about a 6.5% or higher earnings yield. And I held it through yesterday's close. I would have averaged over 13.5% per annum. That's a really excellent rate of return. Now, I'm measuring performance at this point simply based on price change and dividends. However, as I stated in the article, and I want to really emphasize this throughout this video, measuring performance without simultaneously measuring valuation is a job half done. Because if I take this same calculation, the same time frame, and measure it on what I believe the market's fair value would be, then the rate of return would only be about 10%, but that's still extraordinary. But my point is the difference between this and this is what I called in a previous article, false profits. If I bought the index fund here, I would be recognizing today that I'm dealing with a inflated valuation. And so if I'm comparing this to other investments I might have, which I'm going to do here in a moment, I also got to recognize that the S&P is moderately overvalued right now. So when I'm looking at the S&P's performance over, this time frame, if I'm using this as my example time frame, and I'm doing this well, I also got to recognize that I've got very high probability that if the market were to revert to the mean, and I'll do it by the year end, that I could, actually see my rate of return, my annualized rate of return drop rather precipitously. So that's the market, and that's kind of where we are with the market. But let's look at another example. Let's look at tech stocks here, and I want to make a point here now about this idea of time in the market versus market timing. This is clearly a bubble. Cisco got ridiculously overpriced. Now, this went on for years, even prior to what I'm able to show you here in this graph. But if you look at Cisco's peak valuation, where the PE was over 160 and the stock was trading at 77, I want you to notice that was in March of 2000. Cisco hasn't even smelled 77 again. In other words, we're nowhere near close to that. And so even if you'd have bought and held the stock for all these years, you would have actually lost money. Your annualized rate of return, including dividends, which I might point out started in 2011, you would have still had a negative rate of return. So if you're really overpaying for a stock like Cisco or any other stock, time becomes your adversary. Now, even after this massive correction, Cisco was still trading at very high multiples relative to its growth. So even had you bought it somewhere in here where the stock had corrected, it tried not to hit the perfect bottom and still held it all the way through the next recession, you'd have still had a very, very poor rate of return from 2002 to 2012. I would clearly call that a lost decade. A rate of return of only 2%, including dividends. You would have actually, had a very, very weak performance. And yet, if I looked at the business during this time frame, Cisco, the company, did extremely well. So when you invest in a stock when it's overvalued, time becomes your adversary. Now, using this same example, if I'd have been smart enough to buy Cisco sometime during the recession, again, I'm not going to pick the very bottom. Here I'm paying a PE ratio of just under 12 to buy the stock. If I'd have held it for several years later, I'm looking at 4 or 5 years, so I'm making about 5% a year, but I'm not making a great deal of money, but I had a lot of volatility in between. I had periods where my rate of return was significantly worse, and I had periods, of course, where it was an awful lot better. Here's a negative rate of return going through August of 2011. I would have had a very nice rate of return where it got overvalued again coming out of the Great Recession initially, where I'd have been annualizing it over 30% a year, but that's for a very short period of time. But the point is if I bought it there and held it to here, this is an actual rate of return of around just under 11% a year, but it's based on fair value. And that's the point I want to make. So 10,000 over this time frame grew to 31,400. Had I measured this at its peak here, my 10,000 would have grown to 35,000. I've averaged 13%. But when I see this, I recognized, or I would have recognized, that I'm also got to measure valuation, that the stock was overvalued here. Now, of course, we've had this correction where the stock has reverted back down to its intrinsic value. And so my rate of return has now dropped to 11%, but that's still very attractive. But I recognize that to be the case. The point is, time becomes my friend in this example. Now let's move to the other, what I'll call famous tech stock, and let's take a look at Microsoft and see how valuation has affected Microsoft and its rate of returns. Now, in contrast to Cisco, it also got into bubble territory. PE got over 71, almost 72 times earnings, and as a result, you could have held Microsoft. I want you to notice the price is 58 here, and if I just run my mouse along the top here, it took me all the way out to 2015, 2016, actually into 2016, before I would have actually seen that $58 price again. Let me see if I can find it here. Here we go, right here. That's about $1 short, but I had this whole time from 1999 to 2016, I averaged less than 1% annualized, and that includes dividends. I actually would have had negative growth. 10,000 would have shrunk to 9,700. Time, all this dead money and all this dead time. Now, let's look at it differently. Let's assume that we bought Microsoft in the Great Recession while it was happening, but we bought it when it was fairly valued. Now, I also talked about this in the article. I want you to notice that it did drop. It fell from the $28 a share here all the way down to $16 a share. That's about a 43% drop. But because the stock was fairly valued here, I want you to notice that it recovered almost immediately. It wasn't, little less than a year or so, or maybe slightly over a year before I got back to break even. On the other hand, Had you bought it when it was overvalued back in October of 2007, when the PE was in the mid-20s, you still didn't recover your money here. You paid 37, we'll call it 36.80. You didn't get back to that $36, $37 a share till 2013. Overvaluation, again, hurt your bottom line. But when you bought it at fair value, where the PE was just under 15, your rate of return now is almost double digit. It's up to 10% a year. But the point is, it took a lot of years for that to happen. Now, right now, Microsoft is trading at an extremely high valuation, as I think you can see. So had I bought it here, I would have been very happy to see the price here today, which would have averaged over 10% a year plus a nice dividend for a AAA rated, one of the highest quality companies on the planet. However, my rate of return has actually been something closer to 17% a year, and that's awesome. And I certainly love that. And by the way, I love Microsoft. I think it's one of the greatest companies on the planet. What I don't like is the valuation. As the old joke goes, the definition of appreciation is when the other party appreciates what you have more than I do. But my point is this: when I'm measuring this performance from, I'll call it fair value here, up to this, what I'll call excessive valuation, I've got to recognize that I'm taking a lot of risk here, because from here forward, I could see very weak rates of return on this common stock if and when the market decides to get the stock back into its reasonable valuation. So valuation is a long-term concept. You don't expect to make money very quickly. If I go and look at a stock like Lockheed Martin, for example, and I could look at General Dynamics or several others, I want you to notice there was a period, it came into the Great Recession, I'll call it fairly valued. All right, now the company earnings were relatively flat here for this period of time, and I would have made about 5.8% a year. But I want to show you something. If I use my scroll bar here and scroll this to that time frame here, and I'm going to go ahead and get these out of my way. If I scroll this back to this time frame, what I want you to notice is that the time frame I've measured here, that you actually had Lockheed Martin growing at about 2.5% to 3%. I need to go out a couple more years. It was actually growing at about 5%, and I made about 5% annualized. So the point is, the fundamentals were strong here. They weren't the strongest they've ever seen, but you weren't seeing collapsing earnings, you weren't seeing losses, you weren't seeing negatives. But I also want you to focus on the dividend. The dividend income actually rose on average about 22% per annum, or just under that. So you had a period of time where you didn't really make a great deal of money, but the stock was undervalued, and it stayed undervalued for many years here. But then all of a sudden, eventually, and this is what I wrote about in the written portion, all of a sudden the stock becomes popular again. And now if I measured performance from fair valuation to here, I'm averaging over 14% a year. But once again, in my mind's eye, I would measure it according to what I think the intrinsic value is. I should be making around 12% a year. So I take this into consideration as the only point I'm trying to make here, ladies and gentlemen. When I'm measuring performance, I want to also measure valuation. And let me put that a different way. What I'm trying to determine is how well the business has performed. And here you see it's grown at almost 10% a year during this time frame. And then I'm trying to measure whether or not my rate of return is consistent and commensurate with that. But if it gets high like it even did back here, if I start at fair value here and measure it to this peak, I end up making 15% a year. I turned $10,000 from September of 08 to January of 2018 into $36,000, including dividends. That's market value plus dividends, and that's a 14.8% rate of return. But then again, if I measure that after this correction where the stock did get back to the mean, my $10,000 is now only worth $28,000, and I've made 11%. The point is, when this was going on, because I'm focused on fundamentals more than price, I would have recognized that I had some what I like to call false profits in here. Nevertheless, when valuations are low, time is on your side. You could get lucky and get overvaluation in the future, or you could just simply have the stock go from fair value, stay undervalued, and eventually get back to fair value and still make a decent amount of money. In this example, I'm hitting here at about 9% a year. So you have to be patient with valuation. It doesn't necessarily manifest manifest itself quickly, but sometimes it can. Let's use an example. Let's look at CVS real quickly, and this will be my last example in this video just for sake of time. If you look at CVS long term, I want you to notice that the company's price has tracked earnings very consistently over a very long period of time. In other words, I'm using a normal PE of 16.7 on this long-term graph, and I'm using a fair value of 15. So these are my valuation reference lines, and you can see the stock has traded most of the time actually above these valuation reference lines. There was a period where it got undervalued, and again, there was a 2 or 3 year span here where the stock didn't do that well. Then it became overvalued, and then, of course, now they've made this Aetna purchase, and we've got the company, the stock price went from being vulnerable, being highly valued. Now, again, if I'd have bought it at fair value here, and I would have measured my rate of return up to here, I would have turned $10,000 into $38,000, averaged over 22% a year. However, if I would have measured that going back to fair value, that $10,000 goes to $29,000, a longer period of time, but my rate of return drops down to 14%. Now, that's still excellent, but the point is this would have been false profits up here that eventually manifested. And of course, ultimately, if I'm looking at this, the stock ends up going into this undervalued territory and my rate of return really drops. This is not predictable. The moving in alignment with fair value is predictable. And of course, the last lesson that this CVS shows us is that when the stock really got cheap, now I want to make a point. The company is expected, because of its recent acquisition, they're expected to freeze their dividend for the next several years. You can see that the white line has flattened out, but the stock got ridiculously cheap. And by April, it was trading at a PE of 8. We've now had the PE advance to almost 11. And just over last year, from April of 2019 through January 15th of 2020, we've seen a 38% increase in this stock as it's moving back into alignment with fair value. And you have still a long-term opportunity, even with no growth or very little growth expected for the next couple of years. If this just moves back into alignment with its more normal valuations, you've got double-digit rate of return potentials and a stock that's paying you over 2.5% dividend income. So when you're dealing with valuation, don't just measure performance, because the stock price, as you can see, is very unpredictable. It can be excessively high or excessively low at any point in time. Focus on the fundamentals of the stock, because that's where the true insights are going to be. Anyway, this is Chuck Carnevale saying thanks for watching. I hope you enjoyed the video. Look forward to talking to you again real soon. Thanks again for watching.